10 million? What are you adding a day?
So we've been growing.
Before 2013, the stock market wasn't just a private club, it was a fortress designed to keep you out. For decades, if you wanted to buy a piece of a company, you had to pay tribute to a gatekeeper. That gatekeeper was a brokerage, and the tribute was a commission $7, sometimes $10, for every single trade. If you scraped together $100 to invest, your stock had to soar 10% just for you to break even. It was a rigged system, built by Wall Street for Wall Street, and it forced millions of ordinary people to the sidelines to watch the rich get richer. Then, two friends from Stanford asked a question so radical, it sent a shockwave of terror through the financial establishment. What if we burn the entrance fee to the ground? This is the story of how Vladimir Tenev and Baiju Bhatt, two outsiders, saw a corrupt system and decided to smash it. Their simple, almost naive question didn't just launch a company. It started a bloody revolution that would bring the titans of finance to their knees and spark a firestorm over who truly gets to build wealth in America. To understand the world that birthed Robinhood, you have to stand in the ashes of the 2008 financial crisis. Trust in the big banks had completely disintegrated. The system felt like a casino where the house always won, a raw anger that exploded into the Occupy Wall Street movement in 2011. Protesters took over the heart of New York's financial district, their cardboard signs screaming about a nation fractured between the 1% and the 99%. An entire generation was suffocating under a mountain of student debt, haunted by economic anxiety and filled with a burning suspicion of the institutions that had failed them. For this generation, the stock market wasn't just intimidating, it felt like a sick joke. The tools were archaic, built for dusty desktops in a world screaming for mobile. The language was an impenetrable jargon designed to confuse and exclude. And worst of all were the fees. That $10 commission was an insurmountable wall if you only had a few $100s to your name. It was a vicious trap. You needed money to make money, but the price of admission was designed to keep you poor. Wall Street had built its fortress, and for the 99%, the drawbridge was permanently up. The frustration was a powder keg. Technology was shattering old barriers in every other industry, but Wall Street remained untouchable, arrogantly clinging to its old, expensive ways. The stage was set for a rebellion. All it needed was a spark. The architects of this rebellion weren't groomed in the corrupt halls of Goldman Sachs. They were math prodigies from Stanford. Vladimir Tenev and Baiju Bhatt, the sons of immigrants, met as classmates. Tenev, born in Bulgaria, had parents at the World Bank. Bhatt's parents were Indian immigrants, his father, a NASA researcher. They weren't insiders, they were brilliant outsiders who saw the world not through the lens of financial pedigree, but through the cold, hard logic of numbers. After college, they moved to New York and walked straight into the belly of the beast. They founded companies that built high-frequency trading, HFT, software for the very hedge funds and banks that lorded over Wall Street. This was their Trojan horse. They were building the secret weapons for the financial elite, getting a raw, unfiltered look at the system's plumbing, the complex engines that allowed institutions to profit in milliseconds. They were on the front lines, but they were still outsiders. When Occupy Wall Street exploded, a friend confronted them, accusing them of being part of the problem of getting rich by helping the 1% rig the game. The accusation was a gut punch. It stuck. They were building tools for their enemies. They began to wonder, what if they could take this insider knowledge and turn it into a weapon for everyone else? Their work in high-frequency trading exposed a shocking, hidden truth. Tenev and Bhatt saw with their own eyes that the actual, technological cost for a brokerage to execute a trade was virtually nothing, fractions of a penny. Yet, the industry was brazenly charging ordinary people $7 to $10 for that same service. The markup was obscene. It was like paying $500 for a bottle of water. The price had nothing to do with cost and everything to do with corporate greed and an iron grip on the market. This was their aha moment. The entire commission model wasn't just a business practice, it was a lie. A relic from a pre-digital age that the big firms had no incentive to change because it made them billions. For Tenev and Bhatt, this wasn't a market inefficiency, it was a profound, systemic injustice. They saw the chasm between the hyper-advanced technology they built for Wall Street and the grim reality their friends faced, locked out, and left behind. Their mission was forged in that moment of outrage. Build a brokerage with zero commissions, use technology and a mobile-first design to gut the middlemen and give all the savings back to the user. They wouldn't just lower the barrier to entry, they would detonate it. Their slogan became "Democratize Finance for All," a righteous rallying cry rooted in the dirty secret they had uncovered from inside the machine. Trading should be free. A revolutionary idea is worthless without the will to fight for it. Tenev and Bhatt were rejected by 75 different venture capitalists. The industry saw them not as innovators, but as a threat. To breach Wall Street's fortress, they needed regulatory approval, mountains of cash, and a way to start a fire. They decided to launch, not with a product, but with a weaponized promise. In 2013, they threw up a simple website with a killer hook: commission-free trading. Stop paying up to $10 for every trade. Below it, a single button to join a waiting list. Then, they turned that list into a viral engine. Refer a friend, and you jump ahead in line. It was a brilliant piece of psychological warfare, tapping into exclusivity and a desperate hunger for access. By the time the app finally launched on the App Store, in March 2015, the waitlist had swelled to nearly 1 million people. They had spent virtually nothing on marketing, but had amassed a grassroots army. The app itself was a revelation, dangerously sleek and intuitive. It felt more like a game than a financial tool. You could buy a stock with an addictive swipe. Vibrant colors and a literal burst of confetti celebrated your first trade, a design choice that would later draw accusations of gamifying investing. This focus paid off. In 2015, Robinhood won a prestigious Apple Design Award, validating their approach. They hadn't just built a cheaper brokerage, they had built a more seductive one, perfectly engineered for a new generation. Robinhood's launch was a declaration of war. For years, the legacy firms, Charles Schwab, TD Ameritrade, E-Times Trade, had operated like a comfortable cartel, their fat commission fees moving in perfect unison. Robinhood blew up their truce. A flood of new investors, long shut out by high fees and impenetrable websites, poured into the market. Armed with nothing but a smartphone, they could now start investing with pocket change. The impact was an earthquake. Robinhood's user base skyrocketed to 10 million by the end of 2019. At first, the old guard laughed, dismissing them as a toy for broke millennials. But they couldn't ignore the exodus of customers. The pressure became a siege. Then, in October 2019, the fortress walls came crashing down. On October 1st, Charles Schwab announced it was surrendering, eliminating commissions. Hours later, TD Ameritrade caved. Within days, E-Times Trade followed. It was a humiliating capitulation. In 1 week, the business model that had defined Wall Street for a century was dead. Two guys, rejected by 75 investors, had forced the industry's giants to sacrifice billions in revenue. The zero-commission wars were over. Robinhood had won. But a dark question hung over the revolution, growing louder with every new user. If trading is free, what's the catch? The answer revealed a controversial, murky practice at the heart of their entire business: payment for order flow, or PFOF. When you place a trade on Robinhood, it doesn't go to the New York Stock Exchange. Instead, Robinhood bundles your orders and sells them to the highest bidder, massive, high-speed trading firms, or market makers, like Citadel Securities. These firms pay Robinhood for the right to execute your trades. This is Robinhood's lifeblood. The market makers profit from the tiny bid-ask spread, the fraction of a penny gap between buying and selling prices. Scaled over millions of trades, these fractions become a mountain of cash, and they kick a piece back to Robinhood. This creates a glaring conflict of interest. Is Robinhood fighting to get you the best price? Or is it sending your trade to the firm that secretly pays them the most? Robinhood swears it's the former, but the model casts a dark shadow over its noble mission. It looked to critics like they hadn't democratized finance at all. They had just found a new, more hidden way to profit from the little guy. In January 2021, every thread of the Robinhood story, its frictionless app, its army of users, and its controversial business model tangled together and exploded. This was the GameStop saga. Hedge funds were betting billions that GameStop, a struggling retailer, would die. They were shorting the stock, a bet on failure. But on a rowdy Reddit forum called Wall Street Bets, a horde of individual investors saw a chance to fight back. Using Robinhood as their primary weapon, they launched a kamikaze attack, buying GameStop stock en masse. This triggered a short squeeze of historic proportions. The stock price went parabolic, rocketing from $17 to over $480. The hedge funds betting against it were hemorrhaging billions, forced to buy shares at insane prices, which only pushed the stock higher. It was a legendary David versus Goliath moment. The 99% were finally winning. But then, on the morning of the 28th of January, 2021, David's slingshot was snapped in two. Robinhood suddenly blocked users from buying GameStop and other meme stocks. You could sell, but you couldn't buy. The betrayal was instantaneous and volcanic. Accusations of manipulation erupted. To millions, it was obvious. Robinhood was protecting the hedge funds, its secret paymasters. The official explanation was far more complex, a collateral crisis with its clearinghouse that demanded billions the company didn't have. But the excuse didn't matter. In the eyes of its users, The company built to democratize finance had just sided with the enemy to save itself. The GameStop fiasco was a near-death experience. It shattered the trust of its most loyal users and dragged its CEO, Vlad Tenev, before a furious Congress. The company survived, but its heroic image was destroyed. It had to desperately reinvent itself and shed its reputation as a gamified casino for meme stocks. The company scrambled to appear more mature. This push had started before GameStop, with the 2018 rollout of commission-free crypto trading and the 2019 launch of fractional shares, which let users buy a sliver of a stock, like Amazon, for just $1. Post-GameStop, this rebranding went into overdrive. Robinhood aggressively pushed into long-term products, launching retirement accounts, IRAs, with a powerful hook, a 1% match on contributions, which later jumped to 3% for paying members. It was a desperate gambit to shift its image from a platform for reckless day trading to one for responsible, long-term wealth. The message was clear: please, forget our past. We want to be your trusted financial partner. Having conquered and then alienated the beginner market, Robinhood now has its sights on a new prize: the sophisticated, active trader it once scorned. The company is frantically trying to prove it's no longer just a toy. This ambition is most visible in Robinhood Legend, a desktop platform with advanced charting and analytics aimed directly at the pros. This pivot is supercharged by a firehose of new products. The company is rolling out risky futures trading, 2, 4-hour trading, and even a branded credit card offering a tempting 3% cashback. In a deeply cynical move, Robinhood has even launched social features to let users copy each other's trades, a blatant attempt to co-opt and contain the very Reddit-fueled energy it was accused of crushing during the GameStop saga. This is the new gamble: to become a financial super app so big, so all-encompassing, that its controversial past is forgotten. As of the 31st of January, 2026, Robinhood has 27.2 million funded customers, an increase of approximately 1.7 million users from the previous year. The platform also supports 28.4 million total investment accounts and serves 13 million monthly active users (MAU) as of the fourth quarter of 2025. This story, from a righteous question to a tainted revolution, is a brutal lesson in what happens when you challenge the powerful. If you want more unfiltered deep dives into the companies and conflicts shaping our world, make sure to like and subscribe. The story of Vladimir Tenev and Baiju Bhatt is a defining tragedy of modern disruption. Two outsiders, armed with code and righteous anger, took on the most powerful industry in the world, and in a way, they won. They didn't just build a multi-billion-dollar company, they forced an entire industry to kill a century-old, predatory business model. Commission-free trading is now the law of the land because of them, but their victory is stained. The very business model that enabled the free trading revolution, payment for order flow, raises disturbing questions about whether they simply created a new, more insidious way to exploit their users. And the GameStop saga, a moment that should have been their crowning glory, ended with them being cast as the ultimate villains. Their impact is undeniable. They gave millions of people access to a wealth-building tool that was once locked away, but Robinhood's legacy is a cautionary tale about the dirty reality of disruption. It's a story of whether they were liberators or just a new set of gatekeepers, and the financial revolution they started is far from over.